Bitcoin is once again sending ripples through the global financial landscape, capturing the attention of investors, institutions, and everyday traders alike as it navigates a critical juncture in its market cycle. In a week marked by heightened volatility and shifting sentiment, Bitcoin has managed to hold on to key support levels even as significant outflows from spot Bitcoin exchange-traded funds have ignited concerns about waning institutional interest and broader market fear. Welcome to Crypto Hub, your trusted source for in-depth cryptocurrency analysis and market updates, where we cut through the noise to deliver clear, professional insights on the evolving world of digital assets. Today, we are examining the latest developments surrounding Bitcoin, exploring the technical foundations that are keeping it stable, the implications of those ETF outflows, and what this all means for the future of the cryptocurrency market as we move through this uncertain period. The cryptocurrency market has always been known for its dramatic swings, but the current situation with Bitcoin stands out because it combines resilience at important price thresholds with underlying pressures that could dictate the next major trend. As of the latest trading sessions, Bitcoin has been testing support zones around the $62,000 to $65,000 range, levels that many analysts consider pivotal, not just for short-term price action, but for the overall health of the bull cycle that began gaining momentum after the halving event. This holding of support comes amid a backdrop of macroeconomic uncertainty, including persistent inflation concerns, potential shifts in monetary policy from central banks, and geopolitical tensions that are keeping traditional markets on edge. Investors watching the charts closely have noted that Bitcoin's ability to defend these levels demonstrates underlying strength, as it refuses to break lower despite the negative headlines surrounding exchange-traded fund activity. This resilience is particularly noteworthy when compared to previous cycles where similar pressures often led to sharp capitulation events and extended bearish phases. Delving deeper into the technical picture, Bitcoin's price action reveals a classic battle between buyers and sellers at these key support areas. On the daily and weekly charts, the asset has formed what appears to be a consolidation pattern following a period of distribution, with moving averages like the 50-day and 200-day providing dynamic support that has so far prevented a deeper correction. Volume profiles indicate that buying interest remains present at these lower levels, suggesting that dip buyers are still active and willing to defend the price. However, the fear sparked by ETF outflows cannot be ignored, as it introduces a layer of selling pressure that stems directly from institutional vehicles that were once seen as the primary drivers of Bitcoin's upward momentum. Spot Bitcoin ETFs, which launched with tremendous fanfare and attracted billions in inflows during their initial months, have recently experienced net outflows totaling hundreds of millions of dollars over consecutive days. This reversal has prompted questions about whether institutional enthusiasm is cooling off, potentially due to profit-taking after strong gains or broader risk aversion in equity markets, where Bitcoin has increasingly shown correlation. To understand the significance of these outflows, it is essential to examine the mechanics of how these ETFs operate and their influence on the broader Bitcoin ecosystem. Products from major issuers like BlackRock, Fidelity, and Ark Invest have become barometers for institutional participation in cryptocurrency. When inflows were strong, they signaled confidence and often coincided with price appreciation as the funds purchased actual Bitcoin to back their shares. Now the tide appears to be turning, with redemption requests leading to the sale of underlying Bitcoin holdings, which in turn contributes to selling pressure in the spot market. This dynamic has created a feedback loop of concern, where retail investors and smaller funds watch the ETF data closely and adjust their positions accordingly, sometimes exacerbating the downward moves. Yet, despite these outflows, Bitcoin has not collapsed, which many seasoned observers interpret as a positive sign. It suggests that other sources of demand, perhaps from over-the-counter desks, sovereign wealth funds, or long-term holders, are absorbing the supply without allowing prices to plummet. This absorption capacity speaks to the maturing nature of the Bitcoin market, where liquidity has deepened considerably compared to earlier years when similar events might have triggered 20 to 30% drops in a matter of days. Looking back at historical parallels provides valuable context for the current situation. In previous market cycles, Bitcoin has faced similar episodes of institutional hesitation followed by strong recoveries. For instance, During the 2021 bull run, there were periods of consolidation and minor corrections driven by regulatory news or macroeconomic shifts, yet the asset ultimately pushed higher as adoption fundamentals remained intact. The difference this time lies in the scale of institutional involvement and the regulatory clarity that has improved in several jurisdictions. In the United States, the approval of spot ETFs represented a watershed moment, legitimizing Bitcoin in the eyes of traditional finance. However, with outflows now materializing, analysts are debating whether this represents a healthy reset or the beginning of a more prolonged stagnation. Factors such as the upcoming Federal Reserve decisions on interest rates play a crucial role here. If policymakers signal a more dovish stance, it could alleviate pressure on risk assets like Bitcoin, encouraging capital to flow back into higher-yielding opportunities. Conversely, sustained higher rates could keep investors cautious, favoring cash and bonds over volatile cryptocurrencies. Beyond the immediate price action and ETF flows, it is important to consider the on-chain metrics that offer a more nuanced view of Bitcoin's health. Data from blockchain analytics platforms shows that the number of active addresses and transaction volumes have remained relatively stable, indicating that network usage is not collapsing despite the market fear. Long-term holders, often referred to as hodlers, continue to accumulate or at least refrain from selling, as evidenced by the declining exchange balances where Bitcoin is being withdrawn to cold storage. This behavior aligns with a narrative of conviction among the most dedicated participants who view current dips as buying opportunities rather than reasons to exit. Meanwhile, miner activity provides another layer of insight. With the halving having reduced block rewards, miners are under pressure to manage their operations efficiently, and some have been forced to sell holdings to cover costs. This selling has contributed to the supply overhang, but increased hash rate and network security demonstrate that the infrastructure remains robust, reinforcing Bitcoin's position as the most secure decentralized network in existence. The fear sparked by ETF outflows has also spilled over into the broader cryptocurrency market, affecting altcoins and related sectors in varying degrees. Ethereum, for example, has shown mixed performance, holding its own but lacking the same level of institutional tailwinds that Bitcoin enjoys through its ETFs. Smaller tokens and DeFi projects have experienced sharper declines as risk appetite diminishes and capital rotates back to perceived safe havens within the crypto space. This rotation effect is typical during periods of uncertainty, where Bitcoin's dominance tends to increase as investors seek the asset with the strongest fundamentals and brand recognition. Market observers note that Bitcoin dominance metrics have indeed ticked higher recently, supporting the idea that the king of cryptocurrencies is once again acting as a flight to quality within the digital asset universe. For traders navigating this environment, understanding these intermarket dynamics is essential for positioning portfolios effectively, whether through spot holdings, derivatives, or diversified exposure across different blockchain ecosystems. Regulatory developments continue to shape the narrative around Bitcoin and its market stability. In various regions, governments are advancing frameworks that could either support or hinder growth. The European Union's MiCA regulations aim to bring clarity and consumer protection, potentially attracting more institutional capital once fully implemented. In Asia, countries like Singapore and the UAE have positioned themselves as crypto-friendly hubs, drawing businesses and talent away from more restrictive environments. In the United States, ongoing debates in Congress about cryptocurrency legislation remain a focal point, with any positive progress capable of boosting sentiment significantly. These macro-regulatory trends intersect with the ETF story because greater clarity tends to encourage larger allocations from pension funds, endowments, and other conservative investors who require compliance certainty before committing capital. The current outflows may partly reflect a wait-and-see approach as participants assess the evolving policy landscape. Economic indicators from the traditional finance world also warrant close attention in relation to Bitcoin's performance. Inflation data, employment figures, and consumer spending reports all feed into expectations for central bank actions, which in turn influence liquidity conditions. In an environment where liquidity is abundant, risk assets like Bitcoin tend to thrive. When liquidity tightens, corrections become more pronounced. The recent ETF outflows coincide with a period where Treasury yields have fluctuated and the dollar index has shown strength, creating headwinds for commodities and growth-oriented investments. Bitcoin, often described as digital gold, has characteristics of both a store of value and a growth asset, leading to complex correlations that analysts study intently. Some experts argue that as Bitcoin's market capitalization grows and its integration with traditional finance deepens, its behavior will increasingly mirror that of other large-cap assets, reducing extreme volatility over time while maintaining upside potential tied to technological adoption. Examining the role of derivatives markets adds another dimension to this analysis. Open interest in Bitcoin futures and options has remained elevated, with funding rates indicating a balanced but cautious sentiment among leveraged traders. Liquidations have occurred on both sides during recent swings, but without the cascading effects seen in more extreme events. This suggests that while fear exists, the market has not reached panic levels where forced selling dominates. Perpetual swaps on major exchanges show that bulls and bears are engaged in a tug-of-war, with neither side achieving decisive control. For those following the options market, implied volatility levels provide clues about expected price ranges in the coming weeks and months. Elevated implied volatility often precedes significant moves, whether upward or downward, making it a tool for risk management and opportunity identification. As we consider the psychological aspects of the market, it becomes clear that fear, while uncomfortable, can create favorable conditions for disciplined investors. The phrase "buy fear, sell greed" has become a guiding principle in cryptocurrency circles, and the current environment tests the resolve of participants. Media coverage tends to amplify negative developments, such as ETF outflows, while sometimes underplaying the resilience shown at support levels. This asymmetry in reporting can contribute to emotional decision-making among less experienced investors, leading to suboptimal outcomes. Professional analysis, grounded in data and historical precedent, encourages a more measured response. Bitcoin has survived numerous challenges since its inception, from regulatory crackdowns to economic crises, emerging stronger each time due to its fixed supply, decentralized nature, and growing utility in areas like remittances, payments, and as a hedge against fiat currency debasement. Looking ahead, several scenarios could unfold from this point. In a bullish case, Bitcoin successfully defends current support, ETF outflows stabilize or reverse as bargain hunters enter, and positive macroeconomic catalysts propel prices toward new highs. Resistance levels around $70,000 and beyond would come into focus, with potential for renewed institutional inflows driving momentum. In a more neutral or bearish scenario, prolonged outflows combined with external shocks could test lower supports, perhaps in the $50,000 range, offering even deeper value opportunities for long-term accumulators. Most analysts favor the former over extended downside, citing improving fundamentals and increasing mainstream adoption. Corporate treasuries continue to add Bitcoin to balance sheets, with companies citing its potential as an inflation hedge, an asymmetric upside. Nation-state interest, while still nascent, represents another frontier that could transform demand dynamics in the years to come. Education and awareness play vital roles in navigating these markets responsibly. New participants should focus on understanding wallet security, risk management techniques, and the distinction between different types of crypto assets. Bitcoin's position as the original and most established cryptocurrency gives it a unique moat, but the ecosystem as a whole benefits from innovation in Layer 2 solutions, smart contracts, and decentralized applications. The fear sparked by recent events should serve as a reminder of the importance of due diligence rather than a signal to abandon the space entirely. Those who approach cryptocurrency with a long-term perspective, viewing volatility as part of the journey rather than an insurmountable obstacle, tend to fare better over multiple market cycles. In exploring the ETF phenomenon further, it is worth noting how these vehicles have democratized access to Bitcoin for traditional investors who might otherwise avoid direct custody of digital assets. By providing exposure through familiar brokerage accounts, ETFs have lowered barriers and increased legitimacy. The outflows, while concerning in the short term, may reflect portfolio rebalancing rather than a fundamental loss of faith. Investors might be rotating profits into other asset classes or simply taking a pause after substantial gains. Tracking the premium or discount to net asset value for these ETFs offers additional insights into supply and demand dynamics for the shares themselves. When premiums expand, it often signals strong buying interest, whereas discounts can indicate selling pressure or reduced enthusiasm. The global macroeconomic environment adds layers of complexity to Bitcoin's story, with central banks around the world managing post-pandemic recovery, debt levels, and currency stability. Bitcoin's narrative as an alternative store of value gains traction during periods of monetary expansion. Quantitative easing programs in the past have correlated with Bitcoin rallies as excess liquidity sought higher returns. Should similar policies re-emerge, the asset could benefit disproportionately. Conversely, fiscal austerity and rate hikes create challenging conditions, testing the conviction of holders. The interplay between these forces makes Bitcoin a fascinating subject for economists and financial theorists who debate its classification as currency, commodity, or technology. Community sentiment, while difficult to quantify precisely, remains an important undercurrent. Social media discussions, forum activity, and developer engagement all reflect a vibrant ecosystem that continues to build despite price fluctuations. Open source contributions to the Bitcoin protocol ensure ongoing improvements in scalability, privacy, and functionality. Lightning Network adoption, for instance, addresses transaction speed and cost issues, expanding use cases beyond simple value storage. These technological advancements provide a foundation that transcends short-term market noise, supporting the thesis that Bitcoin's value proposition strengthens over time. As we synthesize these various elements, the picture that emerges is one of a market in transition. Bitcoin is holding key support amid ETF outflows, demonstrating resilience that deserves recognition. The fear being sparked is real, but should be contextualized within the broader evolution of the asset class. Investors, whether institutional or retail, are well advised to maintain diversified approaches, stay informed through reliable sources, and avoid emotional reactions to headline volatility. The coming weeks and months will likely bring further clarity as economic data releases, regulatory updates, and on-chain developments unfold. CryptoHub remains committed to providing balanced professional coverage of these developments, helping our audience make informed decisions in a complex landscape. The cryptocurrency journey is filled with both challenges and opportunities, and understanding the nuances is key to long-term success. Whether you are a seasoned trader monitoring support levels or a newcomer curious about Bitcoin's potential, the current environment offers lessons in patience, analysis, and strategic thinking that extend beyond any single market movement. In conclusion, while Bitcoin shakes the market and ETF outflows generate headlines filled with fear, the asset's ability to hold critical support levels underscores its enduring strength and the maturing dynamics at play. We will continue to monitor these trends closely and deliver timely updates. Thank you for joining us today on CryptoHub, where insightful cryptocurrency analysis meets professional market reporting. Be sure to subscribe and stay tuned for more in-depth coverage as the Bitcoin story continues to unfold.